Hong Kong's major commercial banks have kept their prime rates unchanged, a move that was welcomed by the property sector and home buyers. The lender's decision came after the city's de facto central bank raised its base rate by a quarter point, following the same increase by the U.S. Federal Reserve. Chloe Feng reports.
The U.S. Federal Reserve underlined its commitment to stem runaway inflation by raising interest rates at its 9th straight meeting. It pushed the federal funds rate by a quarter of a percentage point to a range of between 4.75% and 5%, the highest level since 2007. The increase came despite calls for a pause after 3 banks in the United States and Europe collapsed over a 10-day period. Local strategists welcomed the fast balancing act.
I think it's the best decision compared to half a percentage point increase or a pause. If they choose to pause now, then it may actually trigger panic selling in risky markets. But on the other hand, if they insist on the half percentage point increase, then they may overshoot and they may drive the U.S. economy into a recession.
In reaction to the fast move, the Hong Kong Monetary Authority increased its base rate by a quarter point to 5.25%. But for the second time in a row, local commercial banks decided to not follow suit and kept their prime rate unchanged. HSBC said it would maintain its prime lending rate steady at 5.625%, with its subsidiary Hang Seng Bank following in its footsteps. Standard Chartered's rate remains steady at 5.875%. Analysts said this could signal the end of rising interest rates by Hong Kong's commercial banks, a move which would come as a relief to home buyers. But monetary authorities warn people to stay cautious and be aware of the rate volatility and the risks of loans. Chloe Feng, HKIBC.